In 2 days, Bill Hwang lost $20 billion. Not 20 million. 20 billion. He wasn't reckless, he wasn't dumb. He ran one of the most sophisticated funds on Wall Street. And one tool turned his fortune into dust faster than almost anyone in history. That tool was leverage. Leverage feels like a shortcut to getting rich faster. It's actually the most common way brilliant people go broke. Today, it'll show you 3 collapses, real names, real numbers, and the one thing they all share. Here's the number nobody wants to hear. If you borrow to double your position, a 50% drop doesn't cut your money in half. It erases all of it. Go back to 1929. Regular people were buying stocks on 10% margin. That's 10-to-1 leverage. It felt like genius on the way up. Then the market turned. A stock only had to drop 10%. Just 10. And your entire investment was gone. The margin call came. You had to sell. And millions did, all at once, into a falling market. But here's the part that should scare you more. The people who lost the most in the next story were the smartest people in the room. In 1998, a fund called Long-Term Capital Management collapsed. Its founders included 2 Nobel Prize winners in economics. They built mathematical models most humans couldn't even read. And they leveraged those models roughly 25-to-1. On paper, flawless. In reality, when Russia defaulted on its debt that summer, their models broke. Markets did what the math said was nearly impossible. They lost $4.6 billion in under 4 months. The Federal Reserve had to organize a rescue just to stop the damage from spreading. So let me ask you something. When the market drops 30% next time, which are you? The investor who can wait it out or the one forced to sell? Tell me in the comments. Wait or forced. And that word, forced, is the real secret of what leverage does to you. Here's what nobody tells you. The real danger of leverage isn't that it magnifies your losses. It's that it steals your ability to wait. Think about it. A value investor's superpower is patience. You buy below intrinsic value, and you wait for the market to catch up. Buffett held Coca-Cola for decades, but you can only wait if the position is yours. The moment you borrow, someone else holds the clock. When the price drops, the lender doesn't care about intrinsic value. They want their money back. Now, so you're forced to sell at the exact bottom, the very moment a patient investor should be buying. That's the cruel twist. Leverage doesn't just make you poorer. It flips you from buyer to seller at the worst possible instant. Buffett said it plainly. It's insane to risk what you have and need to get what you don't need. And the fastest example of this trap happened just a few years ago. March 2021. Bill Hwang ran a family office called Archegos. Had reportedly grown around $10 billion of capital into over $100 billion in market exposure. That's leverage stacked on a handful of concentrated bets. A few of his stocks dropped. The margin calls hit. And because it was borrowed, he couldn't wait a single day. The banks that lent to him got crushed too. Credit Suisse alone lost more than $5 billion. Same story as 1929. Same story as LTCM. Different decade, identical ending. None of these people were fools. That's the whole point. This isn't educational scare talk. It's the historical record. And it should change how you think about risk. Remember what I said at the start? One tool turned a fortune to dust in 2 days. Now you know why. Leverage doesn't make you a better investor. It just makes the market your master instead of your servant. The transformation is simple. When you invest with money that's fully yours, a crash becomes an opportunity. You get to wait, and waiting is where wealth is built. When you invest with borrowed money, that same crash becomes a countdown. Own your positions. Own your time. So be honest with me. Has leverage ever cost you, yes or no? Drop it in the comments, and tomorrow I am breaking down the one balance sheet number that quietly warns you a business is about to unravel. You won't want to miss it.